Boston, 1920. A man named Charles Ponzi promises to turn a few $100s into a fortune in just a few weeks. Crowds line up outside his office, banks pour in money, and the local press amplifies him as if he's uncovered a new financial miracle. Fast forward to 2025, and we're still falling for the same trick. Only now it wears the disguise of crypto tokens, flashy influencers, and social media hype. The answer lies in human psychology, not math. And in this story, you'll see how Ponzi's tactics map directly to modern scams, and the red flags anyone can spot today. The man who started it all. Before diving into why people keep falling for this pattern, we need to start with the person whose name defined it. Here's a surprising detail right at the start. Charles Ponzi was not actually the man who invented the type of scam that bears his name. Versions of it had existed well before he ever set foot in Boston. Earlier versions existed, but Ponzi's scale and the press coverage around him made the scam infamous. What made him remarkable was how he elevated a familiar trick into a spectacle that captivated an entire city. He didn't just run a fraud, he staged an economic event. His success came not from originality, but from timing and theater. That combination allowed his short-lived empire to grow so rapidly that even today his name has become shorthand for this type of fraud. Ponzi claimed to have discovered an opportunity hidden in something few people understood: international postal reply coupons. These slips of paper could be bought in one country and redeemed for postage stamps in another. On the surface, Ponzi's idea sounded like arbitrage. Buy coupons cheaply overseas, exchange them for higher value stamps in the United States, then profit from the difference. He explained it in ways that linked the scheme to global trade and currency shifts, giving it an air of legitimacy. What truly drew people in were the promises he advertised: a 50% profit in just 45 days, or a full doubling of investments in 90 days. No bank, bond, or business opportunity offered anything close to that. It's important to note that investigators later discovered he had only ever purchased a few dollars worth of these coupons as a demonstration. In reality, he never came close to acquiring enough to support the massive payouts he promised. The coupons were a prop, never the foundation. The press, however, did him a huge favor. Instead of raising alarms about the impossibility of his offers, local papers ran glowing stories portraying him as a financial visionary. They described his stylish appearance, his commanding confidence, and the eager crowds outside his offices. He was profiled almost like a celebrity entrepreneur. For immigrant families trying to find their footing in America, these stories seemed like validation. Newspapers in 1920 worked much the same way social media does today. Once they gave their approval, public skepticism collapsed. The broader historical backdrop mattered, too. America in 1920 was optimistic. The First World War had ended, industries were booming, and innovations such as automobiles, telephones, and electric power made sudden transformation feel routine. Headlines were filled with stories of inventors and businesspeople who had turned ideas into instant fortunes. Immigrants especially were hungry for a shortcut to success in this new world. To them, Ponzi's pitch didn't sound absurd. It sounded like progress. Ponzi himself looked every bit the part. He dressed sharply, spoke with poise, and projected unshakable confidence. He rented office space in downtown Boston, side by side with legitimate institutions, and placed ads claiming deposits were secure. The sight of long lines waiting to hand him money created a feedback loop. The very crowd became its own proof that something special was happening. Mechanically, the scheme functioned only because new deposits funded payouts to earlier participants. At the beginning, early investors did receive the 50% return, and those success stories became his most effective marketing. People reinvested and persuaded friends and neighbors to join in. As word spread and newspapers amplified the narrative, trust snowballed. Within months, the operation exploded. Tens of thousands turned over their savings, and in today's terms, the amounts would reach hundreds of millions of dollars. Banks began to feel the strain as customers withdrew deposits to place money with Ponzi. Remarkably, a con artist had managed not only to hook individuals, but to unsettle Boston's financial system itself. That breakneck pace is what set Ponzi's scam apart from previous, quieter frauds. This wasn't a trickle of isolated victims. It was a full-blown financial frenzy. Investors came from all walks of life: shopkeepers, factory workers, professionals, even experienced business people. He managed to brand himself as a universal path to wealth, open to anyone who dared join in. The cultural climate helped him maintain this image. The early 1920s celebrated risk-taking and admired dazzling displays of wealth. Newspapers spotlighted moguls and fortune builders, and Ponzi slipped right into that mold. He posed for photographs, sponsored new ventures, and carried himself like an industrial leader instead of a swindler. At a time when skepticism might have saved people, acceptance and admiration carried the day. Behind the scenes, though, the pressure was mounting. The scheme required a constant rush of fresh deposits to keep repayments flowing. That kind of perpetual motion is mathematically impossible. The instant new money slowed, the entire structure would teeter. For Ponzi, this collapse became unavoidable within the same year. But by then his place in history was cemented. By the summer of 1920, his impact was undeniable. He had collected millions from everyday citizens, rattled Boston's banks, and imprinted his name on finance forever. The term Ponzi scheme entered the vocabulary as a label for any fraud built on paying old investors with the funds of newcomers. Timing, ambition, and public appetite for fast success combined to burn his name permanently into public memory. In a matter of months, what began as a little-known pitch metastasized into a financial wildfire. Though his empire crumbled as quickly as it rose, the blueprint he demonstrated survived. A template for anyone looking to exploit the same weaknesses in trust and desire. Charles Ponzi disappeared into disgrace, but the mechanism thrived through every change in technology and culture. And that is what brings us to the deeper question his story raises. How could so many rational people convince themselves they would walk away with twice their money in just 90 days? Why the scam worked then and now? The real key to his success lay in how easily human psychology could be steered in the right setting. Ponzi understood that people weren't running calculations in their heads. They were responding to emotions and cues that felt urgent, special, and trustworthy. Those same instincts still operate today, which is why the tactics that worked in 1920 look so familiar in digital scams a century later. Urgency was his opening move. He stressed that the opportunity might disappear at any moment due to government intervention or quirks in foreign postal markets. That ticking clock left little room for hesitation. Imagine standing in line, told you had to decide immediately or risk losing a chance to prosperity. The psychology is identical to the flashing countdown timers on suspicious websites or the only 10 spots left tags in an online pitch. Scarcity pressures the brain to act before reason can step in, and Ponzi made sure everyone felt that silence equaled loss. Exclusivity was the second lever. He promoted the scheme as something almost no one else understood, a secret corner of global finance too complex for the average person. Investors felt flattered simply being allowed in the room. Families who had never been close to insider opportunities suddenly believed they had special access. That same appeal drives people today into invite-only Telegram groups or private Discord chats. Whether it's postal coupons then or alpha crypto tokens now, the promise is the same. You're hearing about something the masses are locked out of, and that makes it too good to pass up. The third piece was charisma. Ponzi had an instinct for how to look the part. Clean suits, confident eye contact, warm conversation. It all smoothed over doubts. Once newspapers began describing him as a financial star, the combination of charm and visibility made questioning him seem foolish. That charisma echoes today in influencers posing against rented supercars or speaking with unwavering confidence on live streams. People still find it easier to trust a familiar face insisting wealth is guaranteed than to accept the dull reality that there is no shortcut. Together, these three elements, urgency, exclusivity, and charisma, formed the skeleton of the scam. Modern psychology would call them by the names of cognitive biases: scarcity bias, authority bias, and social proof. Ponzi's waiting crowds on the Boston sidewalks provided social proof, just as visible as screenshots of fake trading dashboards circulate today. Authority came from the newspapers portraying him as a genius. Scarcity came from his constant warnings that the opportunity could vanish any day. He tapped into instincts hardwired into human behavior, long before research papers ever labeled them. This is why many of his investors did not feel naive or reckless. They saw neighbors collecting payouts, coworkers describing success, and local media endorsing his genius. Saying no began to feel riskier than saying yes. Fear of missing out might not have had a name in 1920, but the emotion was unmistakable. It pushed people to reinvest, to recruit, and to silence nagging doubts. That same fear drives digital communities today, where missing one supposed opportunity feels like being left behind by the entire generation. And while the packaging has been updated, the evidence people use to reassure themselves still functions the same way. Where Ponzi's investors proudly displayed handwritten notes and stamped receipts, today's victims forward screenshots from trading apps or PDFs with glossy logos. Both are easy to fake, both provide just enough polish to calm suspicion, and both reinforce the illusion that everyone else is getting paid. At heart, those paper slips from 1920 and the telegram JPEGs of 2025 serve the same psychological role. Proof on the surface, doubt underneath. What makes this more troubling is how adaptable the same strategy can be. Swap coupon arbitrage for crypto staking, plug in social media instead of newspaper features, and the mechanics remain intact. Early adopters boast of winnings, others rush in, skeptics are ignored, and the cycle feeds on itself until the structure collapses. It isn't the math that connects these eras, but the emotions, greed, envy, and the dread of being left out. Despite decades filled with exposés, documentaries, and financial education campaigns, the pattern hasn't faded. Each new generation convinces itself they can ride the wave and exit before it breaks. The truth is harsher. Very few ever manage to leave in time. In Ponzi's day, investors reassured themselves that the system worked because neighbors were cashing checks. Today, speculators repeat the same refrain after seeing screenshots or clips online. Tomorrow, the mechanism will reappear in some other form, wrapped in the confidence of new technology. In the end, what glued the whole illusion together was not Ponzi's cleverness alone, but the amplifiers around him. His urgency, exclusivity, and charisma set the fire, but outside forces gave it fuel. Without that reinforcement, his promises might have stayed confined to a handful of curious investors. Instead, the story magnified until it swept across Boston and destabilized banks. That amplification, the machinery that turned whispers into hysteria, is the missing piece for understanding why the scheme spread so far and so fast. And once you see how it worked in 1920, it's hard not to notice the updated version playing out today. The hype machine, then newspapers, now social media. Who really built Ponzi's empire? Charles was the front man, but the engine behind his rise was something larger, the press. If his promises were the spark, newspapers were the wind that turned them into a roaring fire. In 1920 Boston, the printed page carried enormous authority. A photo above the fold or a glowing feature in the business section could shift public perception overnight. At first, reporters treated Ponzi like a novel curiosity, a bold immigrant entrepreneur who had supposedly uncovered a loophole in international finance. That early, uncritical coverage functioned as free advertising. Readers saw his face in fine suits, learned about smiling crowds outside his office, and read interviews with investors boasting about returns. It was like a daily endorsement, and in a city eager for heroes, the message hit home. Among the local papers, the Boston Post played a decisive role. Its publisher, Richard Grozier, initially ran neutral stories describing Ponzi's soaring popularity. Those articles weren't intended as endorsements, but they acted like them. Circulation rose alongside Ponzi's reputation, as people rushed to be part of the commotion described in print. Yet it was also the Post that later turned against him. Once suspicion grew, its reporters launched an investigation that eventually exposed inconsistencies and drained the hype. But by then, the press had already helped inflate his legend to extraordinary heights. The sequence mattered. What started as passive reporting gave him a credibility boost, and only later did scrutiny catch up. To grasp how this looked on the ground, picture the daily cycle. Commuters stopped at newsstands, unfolded a copy of the morning paper, and encountered photographs of Ponzi presented with the same polish as a rising industrialist. Reports described lines outside his office stretching around the block, and that visual became its own argument. If so many trusted him, how could he be a fraud? The coverage didn't just relay facts. It amplified his aura of legitimacy before readers even considered the math behind his claims. That repetition of image and story made disbelief seem like the stranger opinion. Swap the newsprint for a digital feed, and the pattern feels familiar. Where headlines once validated Ponzi's promises, now it is viral clips circulating on TikTok, YouTube, or Instagram that create the same legitimizing effect. A 25-second video of someone beaming beside a cartoonish price chart, promising quick profits if you join before it's too late, functions in nearly the same way. Likes and comments act as endorsements, just as testimonials in the paper once did. Skim through trending posts, and the rhythm is nearly identical. Excitement, spectacle, and a promise that waiting will cost you. The incentive structures in both eras pull toward hype. Newspapers depended on sales, and a sensational article on Ponzi's wealthy clients sold more copies than sober warnings about impossible returns. Social platforms depend on engagement, and a video claiming overnight riches will always outperform a cautious breakdown of risks. In either system, skepticism is quieter, harder to package, and less profitable to promote. A thoughtful column doubting Ponzi was drowned out by breathless coverage of his success. Today, long-form financial warnings disappear under viral clips of influencers flashing sports cars. This blurs the line between reporting and participation. When papers published glowing stories about Ponzi, the lines outside his office swelled by the next morning. Their coverage helped produce the result it was describing. Social media operates the same way. When an influencer posts about a new token, the sudden rush of buyers drives the price up, which then validates the hype in the eyes of new viewers. The channel becomes part of the scheme, not just a mirror reflecting it. The issue of trust ties it together. In Ponzi's day, newspapers were regarded as near-official institutions. Their failure to warn early was interpreted by many as tacit approval. Investors assumed that if something were dangerous, surely the papers would say so. Today, the validation comes through metrics. When viewers see thousands of comments backing a project, they assume safety in numbers. Remarks claiming, "I cashed out big," mimic the testimonials that once filled Boston newsprint. Criticism, then as now, was either muted or dismissed as envy. That comparison also underlines how low the bar can be. Ponzi needed space in the city's most prominent dailies to appear legitimate. He needed his portrait in print and flattering articles to make his case. A century later, credibility might arrive from a creator recording a clip in their bedroom, cutting in screenshots of supposed winnings they hardly understand. Add upbeat music and fast edits, and the effect lands with the same force the morning newspaper once held. What once required an editorial board and 4 pages now requires a smartphone and a Wi-Fi signal. Yet the tale is not simply one of blind endorsement. The Boston Post eventually did turn its pages against Ponzi, probing deeper into his claims and publishing damaging details. That shift helped unravel his operation, but the timing mattered. By the time those lines of questioning gained traction, Ponzi had already raked in millions. The initial glow of coverage had allowed him to scale in ways no lone con man could have achieved. In other words, a delayed press reckoning still functioned as a megaphone, only one that first amplified, then slowly dismantled. Modern platforms echo that delay in their own way. Fraudulent schemes can run unchecked across feeds for months before regulators or journalists intervene. By then, the momentum has drawn in thousands. The common element is speed. Once hype circulates more quickly than caution, it gives fraudsters the upper hand. In 1920, that speed was daily headlines. In 2025, it is instant uploads. Both create an environment where excitement gets oxygen and skepticism suffocates. The parallels are stark but instructive. Media systems, whether print presses delivering broadsheets or algorithms boosting trending videos, were never designed to protect audiences from illusions. They were designed to maximize reach. When the incentive favors excitement over evidence, it gives scammers the perfect conditions to appear larger than life. Newspapers helped make Ponzi legendary in Boston. Today, online platforms can do the same on a global scale in a matter of hours. The channel changes, but the appetite for spectacle remains steady. So when we ask who really built Ponzi's rise, the answer points back to the amplification machines of his era. Without those breathless articles, his pitch might have stayed small. 100 years later, algorithms play the same role, handing a global megaphone to anyone who knows how to package hype. The first expose that probed Ponzi's numbers actually boosted his profile before it cut him down. And the irony is that attention itself served as a kind of endorsement. The same paradox shapes the media environment today, and that leaves an even sharper question hanging. If amplification made Ponzi into a household name, what happens when the same model powers scams built on global networks and digital assets rather than coupon slips in Boston? The answer lies just ahead: crypto and the new age of Ponzi. In the 100 years since crowds lined outside Ponzi's Boston office, the scheme hasn't vanished, it has simply been repackaged. Today, its most popular disguise is found in the language of cryptocurrency. Terms like staking, liquidity pools, or yield farms sound technical enough to imply real innovation. Yet the structure underneath is almost unchanged. Payouts for early participants come directly from the money that new investors put in. The surface looks like computer code and digital dashboards, but the basic math is the same cycle Ponzi relied on, now accelerated by technology that makes deposits and withdrawals instantaneous. The losses speak to the scale of this transformation. In 2024, the Federal Trade Commission reported that consumers lost $12.5 billion to fraud, with $5.7 billion tied specifically to investment scams, the single largest category. Many of those involve crypto projects that promise stability and high yields. These are not minor stories. They reshape markets, topple companies, and leave millions of ordinary people with nothing. Consider two names already written into economic history: FTX and Terra. FTX, a global exchange once valued in the tens of billions, collapsed when it was revealed customer funds were misused, sending investors and even large institutions scrambling. Terra and its token Luna promised a self-sustaining algorithmic system, only to unravel in a storm of panic sales that wiped out tens of billions more. Each collapse was different in detail, but the principle was the same as Ponzi's old trick. Early confidence was fueled with new money until the instant withdrawals outpaced deposits. Beyond those high-profile implosions, the pattern repeats on smaller stages every day. Influencers issue personal brand tokens, attract enthusiastic followers, and sell out as soon as prices rise. Everyone who bought in late is left stranded. Others join obscure liquidity pools or staking contracts that dangle unrealistic interest rates, not realizing until too late that the payouts were never supported by real revenue. The marketing may use sleek dashboards and specialized jargon, but behind it is only the circulation of deposits. What appears like innovation is often just faster fraud running on better technology. Speed defines this new era. Ponzi needed months to scale and depended on banks and newspapers to build his crowd. Now anyone with Wi-Fi can launch a token in minutes, flood social media with promotional videos, and draw investors from multiple continents within a single day. When doubt finally catches up, the end is just as swift. Billions of dollars vaporize in hours as projects freeze accounts or vanish entirely. What Ponzi once managed neighborhood by neighborhood now plays out globally in real time. Accessibility magnifies this reach. Investors no longer need to visit an office or sign paper contracts. A smartphone and an app make joining seamless. Screens update balances every second with charts angled upward, profits seemingly accumulating with each refresh. This reinforcement convinces participants they are engaging with a transparent, technical system. But those numbers, lines of code on a screen, are no more secure than the hand-signed certificates Ponzi once distributed. The appearance of growth works because it feels constant and personal in a device people check dozens of times a day. The irony is sharp. Cryptocurrency and decentralized finance were supposed to eliminate middlemen and democratize opportunity. In principle, they offered tools for anyone to build wealth. In practice, that openness broadened the scammers' reach. With almost no oversight, anyone could invite strangers to their revolutionary platform and funnel deposits instantly to private wallets. Instead of democratizing gains, many projects ended up democratizing losses. Savers handed over life savings with a few taps, watching numbers climb on screens that would later freeze or vanish altogether. Social dynamics amplify the illusion. A century ago, crowds outside Ponzi's office reassured others that this must be legitimate. Today, groups form in Discord channels, Telegram chats, and influencer comment sections. Every referral code and meme creates the sense of belonging to something bigger. Friends push one another to join. Online communities celebrate rising metrics as if they were a collective achievement. Behind the noise, all that money simply fuels earlier payouts. Numbers on an app, like crowds on a Boston street, become the visual proof people cling to. The collapse stage feels just as familiar across decades. Victims swing between denial and outrage. In 1920, they crowded courtrooms or tried to rationalize their mistake. Now they post screenshots of balances reduced to zero, seek collective lawsuits, or vent frustration in threads and videos. Some admit they ignored warning signs. Others insist recovery is possible even after the money is gone. Psychologically, the attachment doesn't break easily. Confidence once invested in a charismatic figure or a sleek app still lingers long after the collapse. The continuity with Ponzi's model is not loose metaphor, but functional identity. These modern platforms do not generate wealth. They shift money forward until new contributions dry up. That arithmetic never changes. If payouts must come from later deposits, each scheme is destined for failure. Smart contracts, trading bots, or tokenomics cannot alter it. They simply automate it at scale. Like Ponzi's postal coupon story, the technical-sounding explanation distracts from the impossibility. Complexity remains camouflage. This is why every generation is vulnerable. The packaging changes, the language changes, but the cycle is stable. Yield farms and crypto exchanges are simply today's storefronts for an old business model. For a period, participants see real returns and boast about them online. The noise spreads, more people rush in, and the machine hums. When confidence cracks, the entire system unwinds with brutal efficiency. What once toppled banks in Boston can now destabilize whole sectors of a global market. The resemblance makes the present less surprising and more sobering. In 1920, people pitched their hopes on postal coupons. In 2025, they stake savings on tokens that promise impossible yields. The specifics differ, but both recycle money without ever creating it. Human behavior drives each cycle. The lure of effortless profit, the fear of missing out, the quiet belief that maybe this time technology makes it different. Collapse follows every time, because confidence is fragile and math is unyielding. What we inherit from Ponzi, then, is not just a word for fraud but a recurring template. Technology has already reshaped power, speed, and reach, but the fragile core remains unchanged. Now as then, the illusion spreads because people accept the proof they want to see. Headlines, dashboards, glowing testimonials. And now as then, once faith drains out, nothing is left beneath the scaffolding. But understanding the structure only explains part of the story. Technology may accelerate the scam, but psychology decides whether it thrives. The real question is why intelligent people, often experienced, cautious, and aware of risk, still place their savings in systems that collapse the same way every time. That is not only about lies, it is about trust. And trust, more than technology, is the lever every fraudster has learned to pull. How scammers weaponize trust. Scammers do not simply convince people with bold promises. They succeed by shaping environments where trust feels automatic. That is the more difficult truth to accept. A scheme like Charles Ponzi's could not have flourished on numbers alone, because the numbers never worked. What made his offer believable was his ability to present himself as credible. He could step into a cafe, extend his hand, smile warmly, and make a personal guarantee. Many of his early investors walked away not thinking they were reckless, but rather that they were fortunate to spot a rare opportunity conveyed by someone approachable and confident. The setting added weight. Public conversations, a friendly atmosphere, and visible agreement from others reduced hesitation. Trust became the real product, one Ponzi packaged as carefully as any financial promise. That trust was built on cultural and personal cues. For Boston's immigrant communities in 1920, Ponzi seemed relatable. An outsider who had crossed oceans, spoken their language, and now appeared to achieve success in America. He remembered names, repeated promises like solemn vows, and embodied the hope of upward mobility. Even the letters he signed carried symbolic authority, reassuring investors with the appearance of formality. These acts replaced analysis. Few examined what postal coupons really meant, but everyone could recognize a confident man who sounded convincing and treated them with respect. In that environment, personal identity and charisma easily substituted for economic logic. The landscape has changed, but the structure of scams built on trust has not. Today, digital platforms provide the stage. Social media personalities construct brands around visible success. Luxury cars, upscale apartments, extravagant trips. The message is subtle but deliberate. Prosperity itself becomes proof of reliability. Just like Ponzi's smile in a cafe, the curated image communicates that the person must know what they are doing because their life seems to reflect it. Often the actual product is vague, sometimes coaching, sometimes private access, sometimes investment in a new platform. The specifics matter less than the aura of wealth that surrounds the person delivering the pitch. The tactic works especially well in the visual age. An Instagram post featuring a sports car or a TikTok showing trading dashboards can suggest credibility faster than paragraphs of explanation. Viewers rarely stop to ask whether the lifestyle is financed, staged, or rented. The image itself creates persuasion. A century ago, watching a room full of nodding participants encouraged belief in Ponzi's words. Today, scrolling past thousands of likes, comments, and reposts creates the same feeling. If so many approve, it must be legitimate. Social proof, whether in a cafe or on a screen, makes skepticism feel like the minority opinion. Trust has also become commoditized. Where once reputation spread through word of mouth, online reputation is quantified in visible metrics: follower counts, engagement levels, view numbers. A person with hundreds of thousands of followers already looks dependable before they have said a word. Platforms contribute by amplifying accounts with these markers, reinforcing perception of importance. Verification symbols, most notably the blue check, carry additional weight. A badge meant to mark identity is often misinterpreted as an endorsement of credibility. Many assume it implies some form of vetting, even though the symbol has nothing to do with financial honesty. This kind of shortcut is what makes trust so exploitable. A handshake then, a blue check or follower count now. Scammers actively manipulate this perception. It is common for fraudulent operations to purchase fake followers or design comment sections filled with staged praise. To an outside observer, the page looks admired and trusted. Positive remarks, often posted by bots or paid accounts, mirror the enthusiasm of Ponzi's satisfied early investors who rushed back to neighbors with glowing stories. In both cases, the apparent enthusiasm functions as marketing. The appearance of wide approval encourages more people to step in, while in reality, much of that support is manufactured. Celebrity and influencer endorsements compound the illusion. Ponzi benefited from being celebrated by Boston reporters who treated him like a business innovator. Modern operators borrow credibility from well-known public figures. The public often assigns trust across categories, assuming that actors, athletes, or online personalities successful in one field must have done their homework before endorsing an investment. In practice, many endorsements are straightforward business arrangements, with little scrutiny of what is being promoted. Influencer promotion can create false credibility. Watch for paid endorsements and do simple verification checks before assuming legitimacy. Fame does not equal financial expertise yet. Assumptions of safety are drawn from association. These tactics are effective because they bypass rational analysis. In Boston, very few investors questioned whether coupon arbitrage could return 50% in weeks. They trusted Ponzi's demeanor and social proof. In the present, financial jargon about tokens, staking, or yield is rarely analyzed in depth. The key is not that people believe complex formulas. They believe the person presenting them appears honest or admired. Research shows just how strong this effect is. Surveys in 2024 revealed that about a third of Canadian retail investors made investment decisions based on influencer advice. That level of influence demonstrates how trust, once tied to personal contact, now depends on digital personas that feel equally persuasive. This is the opening scammers' exploit. They do not need to invent new mathematics or uncover sustainable profits. They only need to appear dependable long enough to gather deposits. Modern symbols, images of luxury, streams of followers, verification badges, celebrity endorsements, now serve the same role Ponzi's courtesies and handwritten notes once did. For many people, those signals feel sufficient. Doubt is postponed because the surface looks reassuring, even if the foundation is absent. The pattern across time is steady. Scams thrive when artificial signals of trust substitute for genuine evidence. A warm handshake or a signed note was never proof of solvency in 1920. A glossy Instagram feed or a checkmark icon is no proof of safety in 2025. Yet both have convinced large audiences that they were secure. The human tendency to confuse these symbols with substance is what allows each new scam to scale before collapsing. That repetition across decades explains why the same playbook endures with only cosmetic changes. The continuity is uncomfortable because it plays on the same weakness in every generation. Charles Ponzi leaned on persona and assurance. His modern counterparts construct online identities dressed in prosperity. They succeed not by inventing new financial tools, but by adapting to the signals their audiences already trust. The context is controlled, credibility is staged, and deposits flow in until reality interrupts. Each generation assumes it has modern tools to test credibility, but in practice, each stumbles on the same step, mistaking confidence for evidence. The implications matter. If artificial trust can be manufactured so easily, then the challenge for individuals is to distinguish surface credibility from actual security. That begins with acknowledging how often scams are disguised as social proof and borrowed prestige. Understanding the tactics makes skepticism reasonable rather than cynical. The question is whether people could recognize the signals for what they are before the collapse. And that leads naturally to the next problem. If the mechanics of deception stay consistent, then what early signs could have revealed that Ponzi was running an illusion, and which of those same warnings still surround scams today? Spotting the red flags. Spotting warning signs has always separated those who get out early from those left with nothing. In Ponzi's day, the signals were hiding in plain sight, and they remain just as visible today. The key is not identifying dozens of subtle cues, but remembering a few simple rules that, if followed, stop most schemes before they start. The first and most obvious red flag was the return itself. Ponzi promised to double money in 90 days, or deliver 50% profit in 45. Even a basic understanding of banking or business in 1920 made that implausible. Still, investors leaned in precisely because it sounded incredible. The impossibility became the selling point. What should have triggered skepticism instead created desire. That pattern has never changed. In modern schemes, bold claims of 20% per month, guaranteed, follow the same template. The math looks unbelievable, and that's the moment investors should stop. Yet for many, the exaggeration itself feels like secret knowledge. Here the lesson can be stripped down into a short, memorable set of rules. Guaranteed returns? Run. No clear business model? Run. High-pressure tactics demanding fast action? Run. These three are enough to stop most scams. Regulators such as the SEC and Investor.gov have published nearly identical warnings. They explain in plain language that anything offering consistent above-market returns without risk is almost certainly fraudulent. The message has not changed since 1920 because the structure has not changed. The second recurring red flag is vagueness. Ponzi claimed to profit through postal reply coupons. The story was convoluted, and most investors never pressed him on details. Few asked how coupons could be bought overseas, shipped in bulk, and redeemed in the United States for millions without logistical collapse. The picture made no sense, but the vagueness worked in his favor. Ambiguity. Today comes packaged in slick jargon. Promoters talk about staking pools, algorithmic stability, or self-generating yield. It sounds technical, but when stripped down, no real business or product generates the promised profits. A legitimate operation should be able to answer one simple question: how is the money made? If there is no clear answer beyond trust the system, that's a signal to step away. The third marker is pressure and urgency. Ponzi's ads stressed closing windows and limited time. Lines outside his office magnified the sense that acting quickly was the only way forward. Those who hesitated risked missing out. Modern digital operators use countdown clocks on websites, notifications about phases ending soon, or influencers urging immediate entry before prices explode. All of these tactics push action without reflection. Psychologists describe it as scarcity bias, the human fear of losing a once-in-a-lifetime chance. If you feel pressed to decide instantly, that alone is reason to pause. No sound financial opportunity ever vanishes in minutes. Beyond these three pillars, returns, vagueness, and urgency, today's scams carry additional disguises that Ponzi himself never had. Well-designed websites with animated charts and user dashboards substitute style for legitimacy. Paid influencers or outright celebrities lend their names for promotions. Online groups with staged comments create the illusion of mass participation and enthusiasm. Each of these cues feels persuasive, but they are surface elements, not evidence. Regulators consistently warn that design, visibility, or fame substitute for proof. A shiny platform or glamorous endorsement says nothing about financial reality. These signs are not hard to recognize if you look at them directly. The harder step is acting on them. Most people see the red flags but bury their doubts because they want the promise to be true. History repeats not because the markers are invisible, but because hope outweighs caution. One way to resist is by applying a 30-second check before any money changes hands. In the United States, that can mean searching a company or individual on FINRA BrokerCheck or the SEC's investor.gov database. In Canada, a quick visit to CheckFirst or CSA Resources lets you confirm if the platform is registered. In Europe, national financial authorities offer similar search tools. It is no more difficult than looking up a phone number, but taking that single-step filters out a large share of frauds. Think of it this way. In Ponzi's Boston, investors had no online database, no consumer advisories, no open registries. They relied on gossip, printed stories, or the appearance of confidence. Today, those barriers are gone. Verification takes minutes and requires nothing more than a smartphone. For most modern scams, the first red flag you can test instantly is registration status. If the business never shows up in a regulatory search, the conversation should end there. The value of humor in teaching these lessons should not be dismissed. If someone online promises you a luxury lifestyle through a coin you have never heard of, it is easy to be distracted by their rented sports car. A sharper test is to ask for something unglamorous, like their last utility bill or rideshare receipt. Of course, you will never see those, but the thought experiment makes the point clear. Staged images are worthless without substance. Small, almost joking challenges can puncture illusions before they take hold. Alongside humor, practical checklists matter. The difficulty is not abundance of resources, but the will to use them. Investor.gov, FINRA, and similar authorities publish concise advice. Guaranteed returns, complexity without clarity, high pressure to commit money, and unregistered status. These are not hidden obstacles, they are visible features. Even limited financial experience is enough to follow the rule that if you cannot explain how the scheme works to someone else in plain English, it likely isn't real. Remember, Ponzi's victims could have spotted each of these signals. They chose not to press on the contradictions because the promise was appealing. They could have asked basic logistical questions. They could have paused at the implausible numbers. They could have noticed how lined streets and crowded offices pushed them toward rash action. The red flags were everywhere, but went unheeded. Modern investors face the same pivotal choice. Seeing the signs is easy. Slowing down enough to act on them is the hard part. The most effective defense requires building a habit. Before money leaves your account, pause. Ask, is the return realistic? Is the model clear? Am I being rushed? Can I verify registration in 30 seconds? If any answer creates doubt, the safest action is not to proceed. Those 4 quick checks eliminate the vast majority of Ponzi-like operations. What history shows is that victims are not ignorant, they are eager. Urgency and trust cloud what otherwise looks obvious. Once you commit funds, it becomes harder to reverse, because admitting mistakes is psychologically harder than avoiding them. Regulators and education campaigns remind investors of this cycle. They frame prevention as the best, and often only protection, which raises an uncomfortable truth. Detection is possible, but intervention often comes late. Ponzi's warnings were visible long before his collapse, yet official action followed only after the damage was done. That same problem still shapes the financial world today, when regulators arrive too late. It is one of the striking aspects of Charles Ponzi's rise that his downfall was not triggered by skeptical investors pulling away early or by quick regulatory action. His scheme only collapsed once it grew so large that Boston's financial system began to wobble under the pressure. At that stage, investigators and officials were forced to act, not primarily to shield individual savers, but to protect banks and institutions viewed as pillars of stability. Oversight came after Withdrawals strained banking reserves, after thousands of residents had committed more than they could afford, and after public confidence in the city's economy began eroding. Regulators arrived when the collapse was already underway, documenting wreckage rather than preventing it. It is also worth remembering that in Ponzi's era, no dedicated securities regulator even existed. The SEC would not be created until 1934, leaving the 1920s landscape far less equipped to challenge such deceptions in real time. The same dynamic recurs today. In the digital asset boom, rules and enforcement bodies are very much present, yet their interventions usually come after panic has already taken hold. Schemes run freely for months, gaining momentum through online communities, influencers, and press coverage. Only after sudden crashes strip away billions do regulators begin tracing money through shell companies and anonymous wallets, launching lawsuits and freezing accounts. By that point, the funds are gone. Investors are left to pursue slim chances of restitution through courts, receiverships, or bankruptcy liquidations. Headlines about investigations dominate the news cycle after the damage is irreversible, offering a public sense of response but little comfort to those who lost savings. Studies of enforcement trends, from the FTC and ACFE, reinforce this reality. Fraud prosecutions typically follow large collapses rather than prevent them, making intervention more an epilogue than a defense. This timing was vividly illustrated by the collapse of high-volume crypto exchanges. For years, platforms attracted users with promises of low fees, around-the-clock access, and even guaranteed earnings opportunities. Their daily activity sometimes matched traditional exchanges, yet they operated outside licensing structures designed to demand transparency. Social media celebrated user growth as proof they were legitimate, and many mainstream endorsements followed. Only when liquidity crunches exposed hidden misuse of client funds did regulators step in. Lawsuits, account freezes, and bans came after balances had evaporated. The pattern was stark. The very institutions charged with protecting investors appeared only once failure was unavoidable, their role reduced to reconstruction after catastrophe had struck. Another example is found in smaller startups marketed through influencer promotion. Promises of revolutionary trading tools, unique passive income products, or democratized investing apps reached wide audiences because they carried a familiar face. Investors assumed famous promoters had done basic due diligence. Yet oversight bodies hesitated, debating whether these ventures counted as securities or who had jurisdiction when definitions were unclear. While those deliberations dragged on, money flowed in. Some platforms later collapsed outright. When regulators finally fined operators or banned services, investors had already absorbed the losses. Again, the focus was punishment and documentation long after prevention could have mattered. Pace explains part of the problem. In Boston, Ponzi's empire grew to dangerous scale in less than 12 months. In an era of smartphones and global networks, a comparable operation can multiply beyond that level in a matter of weeks. Deposits can arrive from multiple continents overnight. Regulators, however, still move with a rhythm designed for slower economies. Formal discoveries, internal reviews, public hearings, and drawn-out case building. Fraud works at the tempo of frenzy and fear of missing out. Regulation works at the tempo of reports and jurisdictional caution. The mismatch ensures scammers can extract fortunes before official action finds footing. This delay shapes how the public perceives investor protection. Each time scandals erupt, many assume courts and commissions will make victims whole. Instead, enforcement tends to recover fragments of what was lost, and only after years of litigation. For participants who trusted regulations as a shield, it feels like betrayal to learn that the machinery only stirred to life after the horse had bolted. In truth, enforcement is designed to be evidence-based and painstaking. That conservatism protects the public from government overreach, but it sacrifices speed. Scammers know this and exploit the gap, feeding investors hope while calculating they will always outpace oversight. Worse still, global reach makes coordination harder. Frauds today are cross-border by design. A website registered in one country, executives in another, servers in a third. By fragmenting operations, organizers by time while regulators argue over authority. For the saver sending deposits online, these details mean nothing. The reality remains the same. Money disappears fast enough that any jurisdictional wrangling comes too late. In plain terms, scam velocity dwarfs the cautious pace of global oversight. The echo of 1920 is unmistakable. Ponzi was allowed to run unchecked until his fraud became a threat to banks. Ordinary citizens were never the urgent priority. Similarly, regulators today often mobilize only when losses create systemic risk. When billions vanish, when large firms falter, or when markets ripple. The individual is once more left in the gap, persuaded to trust but unprotected when collapse comes. The continuity across time is sobering. Oversight has historically been reactive, not proactive. Regulators arrive with authority, but at the wrong moment. Fraudsters rely on this lag. They believe they can accumulate deposits faster than governments can assemble cases, and time after time, they prove correct. The cycle perpetuates because systemic caution cannot match speculative speed. That leaves a lingering question. Oversight bodies now command data streams and monitoring systems unimaginable a century ago, yet bureaucracy and politics still slow every response. As each new wave of speculative enthusiasm builds, warning signs appear, but official restraint delays interventions until collapse clarifies the threat. The result is an uneasy stalemate between schemes designed to move faster and institutions struggling to close the gap. And yet the question of regulation only explains part of these collapses. Even with better oversight, investors often continue stepping into risky opportunities, persuaded by hope as much as by trust, which raises a different, more uncomfortable line of inquiry. How much of the blame belongs not to regulators or scammers, but to the people who choose to participate? Victims or willing participants? Were Ponzi's investors powerless victims, or were some more like gamblers chasing a quick payoff? That question sharpens the debate every time the story of 1920 Boston resurfaces, because the truth never fits neatly into a single category. It is easy to picture a crowd of unsuspecting savers tricked by a clever con man, yet the record suggests something more complicated. Even skeptical investors often placed money with Ponzi, just in case. They didn't necessarily believe his postal coupon story, or even that such returns were sustainable. But many convinced themselves they could get in, pick up quick gains, and leave before the collapse. This tension between blind faith and calculated risk makes the story more difficult to file under simple deception. Imagine a store owner reading headlines about Ponzi, listening to neighbors brag about doubled deposits, and feeling the buzz of excitement in the city. Doubts may have lingered, yet the fear of missing out held more weight. So the store owner committed a cautious investment. Not because they believed Ponzi had solved global currency arbitrage, but because it seemed riskier to sit out while everyone else claimed success. Early withdrawals gave some a sense of vindication, as they waved their receipts like trophies. The cycle relied as much on this gambling instinct as on outright credulity. Modern parallels are obvious. In crypto forums and influencer-driven spaces, participants often admit they hardly expect stability. They buy volatile tokens, meme coins, or join yield schemes not out of conviction, but out of the hope they can catch a spike and exit in time. Discussions about entry points and catching a pump dominate, while long-term fundamentals are brushed aside. It is contemporary language for the same psychology. Participation is knowing the odds are against you, but believing you might beat the timing. That belief has powered waves of collapses in both speculative tokens and larger projects promising guaranteed yields. This behavior is not about ignorance alone. Scammers exploit both ambition and limited knowledge. Some victims genuinely do not understand returns and interest, so promises of steady profit seem credible. But others consciously ignore math, confident they'll judge the turning point and exit first. History shows how rarely that works. By the time cracks appear, withdrawals freeze, or value vanishes too rapidly to escape. The illusion of control, the idea you can time a collapse, keeps participation flowing longer than logic should allow. Ponzi's investors embodied this contradiction. Outsiders labeled them unfortunate victims, but many internally weighed their doubts and chose action anyway. They believed they were outsmarting the system by arriving early. The machine spun not only on Ponzi's charm, but on participants sustaining it for their own advantage. That is why describing them as victims alone misses something. In many cases, these were people willing to risk caution for a shot at wealth, and their willingness made the scheme larger than Ponzi could manage alone. This dual role is sharper today because information is abundant. Financial regulators publish advisories, governments maintain searchable registries, and countless articles explain scams. Yet many people knowingly step into unstable projects. Some describe it as speculation, others compare it to trading, but more often it mirrors gambling. Influencers deliberately shape this environment, framing their tokens or platforms as elite opportunities only a bold few will claim. The jargon hides the absence of real business, but it barely needs to. The desire for fast profit continues to outweigh examination. Adding to this complexity, research experiments reveal that even those outside traditional investing aren't immune. Studies by the Ontario Securities Commission showed non-investors, those least experienced with finance, were often more likely than active investors to act on influencer promotions. That susceptibility complicates the narrative. It means some people gamble knowingly, but but others, without background knowledge, fall easier for well-packaged hype. Both dynamics coexist, sustaining demand from different ends of the spectrum. Individual cases illustrate how devastating this mix can be. One Department of Justice press release described an Ohio woman who lost her life savings after being persuaded through a romance-linked crypto scam. Here, trust and hope collided with promises of investment profit. Such examples show that scams hook not only through greed, but through deeply human desires for connection and security. The impact is personal, and the losses leave scars beyond finances. That is why framing this entirely as greedy participation is misleading. Opportunistic gamblers and vulnerable victims often exist side by side. Some come armed with cynicism and a plan to exit quickly. Others enter in good faith, but without the tools to test the claims. In both cases, their money fuels the machine. It is here that Ponzi's legacy repeatedly resurfaces. Frauds do not need universal trust, only enough trust mixed with ambition to keep the cycle turning. The motivations reveal how scams are not simply imposed from above, but co-produced by willing audiences. Participants provide deposits, carry enthusiasm into social circles, and publicize early payouts. Their cooperation transforms what could be a small fraud into a citywide frenzy, or in modern times, a global online mania. Without that readiness to believe or gamble, the schemes would collapse immediately. The fraudster writes the story, but the crowd provides the chorus. Language struggles to capture this dynamic. To call every participant a victim suggests only innocence, ignoring those who joined with eyes half open. To call them complicit participants feels unfair to those manipulated or vulnerable. Reality hovers somewhere between. People were deceived, yet they also entered with hopes of exploiting an opening for themselves. This mix of vulnerability and ambition is what defines every large Ponzi-style operation, from Boston in 1920 to crypto in 2025. Acknowledging this is not about excusing the fraudster. Designers of schemes deliberately shape structures to trap the majority and conceal collapse. But flattening the participants' role obscures how ambition sustains fraud alongside deceit. Investors fueled Ponzi's structure. Modern followers fuel every viral coin or scheme. This uncomfortable reality means scams are never just the story of con men. They are also about communities willing to dream of shortcuts despite warning signs. The lesson is sobering. Each generation wants to think of past investors as naive innocents, but the record shows a spectrum. People chase short-term gains openly, then claim betrayal when collapse hits. Both states can be true. They are manipulated and complicit at the same time. Recognizing this duality helps move beyond blame, shifting the conversation toward prevention. Understanding that greed, fear of missing out, trust, and hope all make people vulnerable puts the emphasis on what actions to take, not just who to fault. That recognition also reframes Ponzi's legacy. It wasn't only about a slick operator in Boston. It was about the thousands who bought into his promise, each for their own reasons. Modern echoes carry the same complexity. Projects grow not by genius alone, but because masses of people choose to believe, even briefly, that they can outsmart the collapse. Seeing that pattern clearly makes it harder to dismiss new schemes as tricks only others fall for. And that, in turn, frames the next part of the story. The legacy left behind was not the success Ponzi imagined, but something stranger. His name became an enduring label for fraud, tied forever to false promises and impossible shortcuts. Ponzi's legacy in today's economy. Charles Ponzi never lived to see just how far his influence would stretch into the way people talk about money. What began as one man's short-lived scheme in Boston has turned into a permanent marker in global finance. Not an example of innovation, but a label that peers over every promise of quick returns. His legacy today isn't about what he did in 1920. It's about how his name is still used to frame suspicion and cast doubt across economies a century later. Ponzi once insisted he was destined to be remembered for brilliance. He claimed he had discovered hidden inefficiencies in international markets and would convert them into lasting fortune. To him, his failure was not dishonesty, but a matter of timing. That is how he defended himself even after collapse. But history shaped a different narrative. Rather than associate his name with financial genius, the world turned it into a red flag. Today, Ponzi is shorthand for anything that looks like it depends on new money to pay old investors. This power of the name goes much further than scams. In public debate, the word is applied with reckless frequency. Politicians accuse opponents of running Ponzi-like programs. Commentators compare housing markets, government entitlements, or education debts to his scheme. While the analogy is crude, these systems are more complex than a con artist's cycle. The fact that the word travels so easily shows its reach. It means fragile, unsustainable, or too good to be true. Calling something a Ponzi is a way to dismiss it quickly, regardless of details. His legacy became not one man's fraud, but an enduring cultural device for labeling distrust. This is why the shadow feels heavy in 2025. Genuine innovations fight against it every day. Blockchain networks, digital assets, and decentralized finance represent real experiments in changing how people exchange value. Many projects build transparent systems, push forward technical ideas, and in some cases even provide useful tools. Yet whenever one project fails, the label spreads across the entire space. A high-profile implosion instantly becomes proof for skeptics. See? Just another Ponzi. The association sticks. For developers and investors trying to create something meaningful, the hardest challenge isn't technology. It's escaping a name that was fixed in the lexicon a century ago. The comparison isn't limited to enthusiasts online. Regulators, financial institutions, and politicians all reach for the same label. Critics argue that digital assets rely on continuous inflows of new participants to retain value, making them Ponzi-like whether or not they are fraudulent. The nuance doesn't matter. The conversation tilts toward suspicion. Even projects that submit to audits, publish code, and open their books are forced to defend against the simple accusation. This dynamic is one of Ponzi's lasting legacies. The term narrows every debate by boiling it back to the fear of collapse. Consider how often this short-circuiting plays out. A startup may present a working product, real technical documentation, and a team with industry experience. Within minutes, doubters reduce the conversation to 5 words. Isn't this just a Ponzi? The accusation works because it's visceral. It doesn't require proof. The association with Ponzi alone tilts public opinion toward suspicion. Complex presentations are quickly drowned out, no matter the evidence. The cultural memory of Ponzi gives critics the first move, and in finance, the first word often sets the tone. This irony would have infuriated Ponzi himself. The fame he craved arrived, but only as a permanent warning. Of countless fraudsters across history, his name shouldered the weight alone. Others stole larger sums or ran longer operations. Bernie Madoff, for example, defrauded investors of tens of billions. Yet even Madoff's massive case was described not as unique, but as the largest Ponzi scheme in history. The term itself had already been anchored by Ponzi. Madoff's actions amplified the concept, reinforcing that the label was permanent, cross-generational, and applied to every scheme built on his old mechanics. The cultural reach extends beyond finance. People call pyramid-shaped marketing programs Ponzi-like. Critics accuse new government programs of functioning as Ponzi structures whenever they appear debt-heavy. The metaphor crosses into casual conversation. Anything built on shaky ground can be called a Ponzi. That is the strange weight of his legacy. Few other individuals have left behind such a simple, durable tag for dishonesty. At a glance, it captures the essence of fragility and tricks, whether the comparison is technically right or not. There is humor in the irony. Imagine dreaming of being remembered as a bold financial thinker, only for your name to become so toxic it mockingly applies to everything unstable. It is like launching a revolutionary social network and being remembered instead as the symbol for scams and fake accounts. History doesn't pick its symbols logically. Plenty of swindlers roamed the early 20th century. Ponzi was not the cleverest or the most damaging, but he collided with the media at the perfect time, destabilized banks, and captured Boston's imagination. That timing ensured his name would stick where others faded. This persistence is no small matter in modern markets. Cryptocurrency offers a strong example. Companies design tools, communities rally around projects, and serious developers produce innovations that matter. Yet whenever an exchange fails or a token collapses, the word Ponzi sweeps across headlines and social platforms. It frames all projects as risky shadows of his old scam. Investors hesitate, regulators lean into suspicion, and legitimate work is forced to shoulder the stigma. The label travels faster than any white paper or technical proof. It is blunt, but it resonates. What his legacy reveals is less about one man than about collective psychology. People know the term Ponzi scheme long before they know who Charles Ponzi was. The phrase is universal shorthand for guaranteed failure. His individual story shrinks in importance compared to the symbol itself. The perpetual fascination with Ponzi reflects an uncomfortable truth. People will always chase shortcuts to wealth, and society will always need a way to describe the structures built on recycled promises. His name became that language. The lessons encoded in this cultural memory are simple but sharp. Any promise of effortless profit must be tested. Any cycle that depends on new investment to sustain itself deserves skepticism. The fact that we use his name across politics, policy, and markets shows how deeply we internalize that suspicion. Ponzi no longer matters as an individual. His name is a caution sign that hangs over financial innovation and speculative manias alike. In 2025, that shadow is everywhere. Say Ponzi in any crowd, and people nod knowingly, even if they're unsure of the exact details from 1920. Whole industries must navigate around a label that instantly creates doubt. Some operators wear it openly, others battle against it, but it shapes the environment either way. And that makes the larger question clear. If Ponzi's name still directs suspicion long after his scheme ended, what does that tell us about the persistence of his design? The answer is not just about memory or language. It is about why, over a century later, his blueprint continues to drain billions. That persistence is what makes his legacy matter most now, in this economy, in this generation. Why it still matters in 2025. Over a century has passed since Charles Ponzi promised Bostonians riches, and yet the shape of his scheme remains visible in 2025. His fraud is not a relic preserved in history. It is a living framework that still strips billions from ordinary people every year. The names change, the technologies change, even the pitch changes. But the structure, new money feeding earlier promises until collapse, has lost none of its force. It is not weaker with time. It has multiplied, adapted, and now operates on a global scale where losses can measure in billions within weeks. The mechanics are not mysterious. Innovation supplies the new tools, scammers provide the story, and investors provide the money. Each cycle follows the same simple arc. A new technology or platform sparks excitement. Early adopters claim unusual returns, and opportunists promote themselves as guides to this new frontier. The crowd mistakes novelty for legitimacy, just as Ponzi's investors mistook postal coupons for financial genius. Old scams don't disappear when new tools arrive. They borrow the language of innovation, disguise themselves with jargon, and expand faster than ever. This recycling of tactics explains why every technological frontier has its shadow economy of fraud. In Ponzi's day, the obscurity of postal coupons gave him cover. Decades later, chain letters, boiler room telemarketing, and email marketing each carried their wave of schemes. Today, staking pools, algorithmic coins, and next-generation investment contracts fit the same mold. What changes is only the costume. What persists is the appetite for shortcuts. People convince themselves that advances in technology must also mean advances in easy wealth. For many, the temptation grows stronger precisely when financial pressures mount. Younger generations coming of age in the current economy face rising housing prices, steep education costs, and limited job security. The pressure to move ahead quickly makes them an inviting target. A pitch that promises tenfold returns or freedom from traditional finance sounds not just appealing, but necessary. The desire to take control can turn into an opening for exploitation. Just like Boston's immigrants believed Ponzi could help them belong, young adults now are told that crypto platforms or influencer-driven funds will help them break free. In both eras, the promise of independence is what hooked people. Scammers know where to aim. Platforms like TikTok, Instagram, and Discord concentrate younger audiences, so pitches appear there first. Influencers flaunt luxury cars and claim their success comes from tokens or yield platforms. Recruitment campaigns portray participation as empowerment. The irony is bitter. What is sold as financial freedom often results in lost savings and deeper insecurity. The pattern mirrors Boston in 1920, where newspaper features and neighborhood gossip drove investors into Ponzi's office. Now, digital feeds create the same pressure but multiply the reach. The persistence of these schemes is almost darkly comic. Warnings have circulated for more than 100 years, yet the outcome repeats. Each financial boom produces opportunists who dangle shortcuts to wealth. Every generation insists it is too savvy to fall for the same tricks. Yet each generation does, usually convinced they'll exit in time. The human desire for instant progress does not diminish with warnings. Instead, it adapts to new circumstances, leaving regulators and educators in permanent pursuit. Part of the reason these schemes thrive is the low barrier of entry for those who run them. Ponzi needed only rented office space, polished suits, and persuasive confidence. Today, a laptop and Wi-Fi can launch a scam with global reach. There is no need for factories, products, or even face-to-face persuasion. A fraudster can target thousands with an app, a website, and the ability to craft convincing online images. In this new environment, exposure to scams is no longer rare. It is routine. With every click and every feed refresh, an invitation appears. This is why understanding how Ponzi's model works is not just historical curiosity, but financial survival. Investors today face a landscape filled with links promising opportunity. Apps with yield banners, influencers posting affiliate codes, articles promoting unverified platforms. Few of these claims are examined before money moves. But, stripping promises back to their core, asking whether payouts depend on new deposits, reveals most scams quickly. Awareness creates the difference between avoiding a loss and repeating a century-old mistake. And the scale of that mistake is no longer measured in thousands or millions, but in billions. In 2024, the Federal Trade Commission recorded $12.5 billion in consumer fraud losses, with investment scams the single largest category at about $5.7 billion. These are not abstract numbers. They represent savings accounts emptied, retirements postponed, and families destabilized. Ponzi's blueprint still extracts wealth on a global level, documented in official reports every year. The figures are proof that this is not background noise in the economy, but a recurring and costly threat. This scale is exactly why prevention matters more than repair. Once money vanishes into a scam, recovery is rare and incomplete. Investigations can take years, international boundaries block enforcement, and restitution usually delivers a fraction of what was lost. The only reliable protection is early detection. That is the practical lesson history delivers. Not waiting for collapse, but catching the signals before the scheme gains your trust. There is a simple two-step defense that works better than most people realize. First, pause when confronted with offers of fast, guaranteed, or unusually high returns. That moment of hesitation disrupts the pressure and stops impulse decisions. Second, verify the legitimacy of the business with a regulator's database. Investor.gov in the United States, FINRA's broker check, the Ontario Securities Commission's check before you invest, or the equivalent in Europe and Asia all provide searchable listings. If the name is absent, the conversation should end there. Together, those steps neutralize the vast majority of Ponzi-like operations. These actions may sound basic, but their power lies in their consistency. Most victims knew something felt off, but told themselves urgency left no time to investigate. Ponzi capitalized on that exact hesitation, and his successors depend on the same pattern. Building the habit of slowing down and checking registrations transforms would-be investors from easy marks into cautious participants. Just as importantly, sharing this approach amplifies the protection. Advice passed through families, friend groups, or workplaces can slow the spread of scams faster than regulations alone. Recognizing this shared responsibility makes Ponzi's story feel less like distant history and more like a present warning. His name endures because the mechanisms need no reinvention. They work whenever hope outweighs caution. A scheme thrives when individual safeguards are absent and collapses when communities exchange warnings and resist pressure. The blueprint survives because it is simple, but survival against it is equally simple when people act collectively to undermine its bait. This is why his legacy demands attention now. The risk is not just that individuals might lose money, but that entire markets, or even national economies, feel the ripple effects. Boston's banks strained under Ponzi's weight. In the modern era, crypto implosions have cut billions from global valuations in days. At every scale, trust collapses faster than it can be rebuilt. Recognizing the historical continuity gives context, but applying that recognition through practice prevents future losses. So when we talk about why this history matters in 2025, it is not to memorialize a clever swindler, but to point out that his tools are alive, automated, and reaching further than he ever could. Protection is not about nostalgia or lectures. It is about carrying a clear, repeatable process into daily decisions. Pause, verify, and only then decide. The more people apply those steps, the smaller the space for opportunists to grow. What makes the lesson urgent is not only the money lost, but the realization that human psychology has not changed. Frauds will continue to mutate, attaching themselves to every new technology and every moment of economic optimism. Unless awareness travels faster than deception, the cycle will not break. And this brings us to the final point. If the same urges have carried scams forward for over a century, then the fight is not against a single man in history. It is against recurring instincts, greed, fear, and the dream of sudden wealth that are still waiting to be exploited. The persistence of these instincts is why this story continues to echo into our present moment. Scams don't disappear, they adapt. Each era addresses them in new language and technology, but they still lean on the same levers that Ponzi once pulled. That is why his story serves less as history and more as a practical defense for anyone navigating today's markets. If a post or DM promises guaranteed returns, pause and check it against a trusted regulatory site. Then share the link with a friend before you invest. If you found this useful, drop a comment with a question about a sketchy pitch you've seen. I'll answer in the comments. Ponzi's pattern survives because people still act on FOMO, pause, verify, and never invest in a hurry.